Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Economic Update Post-Stimulus Outlook, featuring Steve Scranton of Washington Trust Bank. This is our second session in our virtual 2021 Building Opportunity Conference. And over the span of this conference, we will cover topics including real estate industry outlooks, trends around ESG programs, and technology and innovations affecting the built world. More information around our conference and sessions, including registration, are available in the links provided in your console, as well as on mossadams.com. And before we begin our webcast today, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to turn the floor over to Elaine Irvin, National Practice Leader of the Construction, Real Estate, Hospitality, and Professional Services Group here at Moss Adams. Elaine?
Thank you, Amy, and thank you to everyone for joining us today. I am really pleased to welcome back Steve Scranton. He is the Chief Investment Officer at Washington Trust Bank. He always has such enlightening sessions, and as I was contemplating this morning's session and what's going on in the economy, there was probably just a few things that came to mind, such as supply chain issues, infrastructure funding, the debt ceiling, labor shortages, inflation, and I think that's just to name a few. And thinking about the ramification it has on all of your businesses. And so I'm going to be really interested in hearing what Steve has to offer on the whole state of the economy and on these issues. And so with that, I'm going to turn it over to Steve. So good morning, Steve, and welcome to the session.
Good morning, Elaine, and hello, everybody. Thanks for having me once again. After I submitted the title for this session, the way things have developed there, I thought maybe the more appropriate title is what I hear so often from our businesses and customers is, what the heck is going on with this economy? So I'm going to try and answer that question for you as we go along. But before I give you, the outline I'm going to give you is first I'm going to tell you where the economy stands right now, so we have a feeling for where we stand. Then I'll give you my outlook over the next 12 months. And then I'll cover areas that I think we should all be thinking about, and I won't necessarily have definitive answers, but trying to stimulate your thought process. So before I tell you where I think where we stand with the economy, I always like to hear from you first. So, Amy, if we can go with our first polling question, what I'd like to know is, how would you characterize your local economy? So you can see your choices there. You think it's still in recession? You think it's slowly recovering? You think it's steadily improving? Or you think it's booming? So if you would just mark the one that's most appropriate for how you view your economy, that'll at least give us a pulse of what the audience is seeing in real time where they are located. And then I'll tell you what I see from a national perspective. So we'll give that just a few seconds. One of the things that I would tell for those who haven't heard me speak before, I always look at the economy through the lens of jobs, because I always feel very strongly that it's jobs that create income for people. Income is the fuel that they use to spend, and spending from the consumer still makes up almost 3/4 of U.S. economic growth. So that's how you're going to see me starting, is walking through from jobs, going to income, going to spending, then going to GDP. And the perspective I'm going to give you is, how far are we in recovering what was lost during the financial crisis? So that is the way we'll walk it through. Give it a few more seconds here for the poll to finish. And what we can see by looking at the poll, the biggest sector is people saying, that their economy is slowly recovering. The next one was that it's steadily improving. And then you can see booming was third, and still in recession was the lowest poll result. So thank you for that response. I'm going to give you kind of the feedback now as we look at the national economy. And since we've got a broad audience participating, I'm going to cover from a state level, but I'm not going to be drilling down to a regional or local level for you today. When we look at the job side and say, well, how have we done with recovering jobs? For the U.S. as a whole, what we have seen is that from February 28th of 2020, which was the month before the pandemic crisis hit, we have recovered 98% of the jobs lost for the U.S. It's not a homogeneous 98%. Very clearly, the goods producing side is doing the best. That would be mining and logging, construction, and manufacturing, because you still had to make things for people. But the service side is what got hit the hardest, especially leisure and hospitality. But if I look at a state level, what I would tell you is it's very definitely not a homogeneous results for the states, because the U.S. did not follow a unified approach to addressing the virus. So you really get mixed results there. What I can tell you is Utah has seen the best recovery at 103%, while Hawaii seeing the slowest recovery at 87% of jobs being recovered, which should make sense to me because, one, they locked down so heavily. Two, they're tourist heavy. And since leisure and hospitality was hit the hardest, not surprising that Hawaii would be the weakest of recovering jobs. One thing I've always told people, and you heard me just at the beginning there say, it's jobs that create income so that consumers can spend. In this situation during the pandemic crisis, it wasn't jobs that created income. It was the government that created income through their $5 trillion of fiscal aid that they provided to consumers and businesses. So the net result is, which may seem weird until you understand that dynamic, even though we haven't fully recovered jobs, all states in the U.S. have recovered spending because of that temporary support they got through those fiscal spending programs. The U.S. as a whole has recovered 110% of their spending levels from February 28th of 20. The best state was South Dakota at 114%, and the weakest state was Wyoming at 104%. I'm going to simply tell you that doesn't mean everything's all cheery and rosy with the world, because that was temporary. Those funds are no longer being distributed. And so now we're getting back to the reality of saying, so how are we going to look with just wages as the primary source of income? And that's going to play out over the fourth quarter, since the last of the fiscal programs, the extended unemployment benefits, ended the first part of September. If we move to spending then, probably no surprise that if you gave the consumers a huge boost to their income levels, they're going to spend some of that. And so what we have seen for the U.S. is that the U.S. has recovered 117% of the spending levels that existed back in February of 2020. The best state was Mississippi. Apparently, they really spent most of their stimulus checks because they are at 138% of the level that they are at before the pandemic hit. The weakest state, apparently people in Ohio, a little more fiscally conservative, saving their money because they are only at 93% of their spending levels that existed back in February of 2020. So you can see it's a mixed bag. What I would tell you, looking at the national data, so far what they've said is that the consumer spent about 40% of the money that they received from the fiscal aid programs. But the perspective that I would give you is when you have $5 trillion, 40% is still a big chunk of money being spent. And that really should help understand why we've done so well in recovering both income and spending. How that rolls to the GDP side, what I would remind you for GDP is a measure of spending in the U.S., whether it's consumer spending, business spending, or government spending. So what we have seen is because of that boost to the income side, the U.S. officially, whether you believe it or say in your area it's the same story, but the U.S. officially fully recovered its lost economic growth by the end of the second quarter, which is the most recent data we have. The U.S. is at 101% of the GDP level compared to the level that existed February of 2020. The best state may seem surprising to some because they had one of the more aggressive lockdown processes. The state of Washington has actually led the recovery at 104% of the GDP levels that existed before the crisis hit. The worst, probably no surprise again, Hawaii at 93%. But I think we need to keep that in mind, is that that's a measure of spending. Now we're going to have to see where we go forward from here. But the main picture that I would give you for where do we stand right now or what's happened with the economy, I'm going to give you the analogy to say, make your point of reference of thinking, especially for any of you like me who had children. I say that what we've seen for 2021 is a sugar high economy, with Congress, passing legislation at the end of 2020 of almost $1 trillion to the consumer, and then another $3 trillion in March. What we got is similar to what you see if you give your kids too much sugar. They're full of energy, running around, they're fun to be with, and then what you get is the after effect, is that the sugar wears off, and then those your kids are sluggish, they're grumpy, they're maybe in a foul mood. And so I'll pause for a minute here because that's really giving you my outlook for going forward, is what does this mean now that the sugar high spending of the first half of the year, where we got 6.5% annualized GDP growth in the first half of the year. I simply say that is not sustainable. It was great that it happened. Hopefully many of you took advantage of the opportunities that came from that. But now there's consequences and side effects that we have to consider. So let me stop here for a minute. We're using the question and answer feature for poll for you to be able to ask questions. So I want to pause throughout as I go to be able to take questions as we go along. And Amy, if we could pull up the second polling question, given what I've told you about spending going away with the temporary spending, the question is, do you think that the government should provide another stimulus check to individuals, since that is currently under discussion by Congress? And Amy, why don't I turn and say, if you have any questions, let me answer those while they're completing the poll results.
All right, perfect. And before I ask you some questions that have come in from the audience, I do want to let the audience know that if you're having trouble seeing the submit button on the polling question, you will just need to enlarge the slide area and then select the answer you choose and hit the submit button. All right, Steve, so a question that has come through is, how long do you think it will take to get the supply chains reopened?
The supply chains, that's a great question because that is the source of pain. That's part of the after effects of the sugar high. One of the features I've said is when you stimulate demand, but you don't increase supply, what you get is supply shortages, higher prices. I think what we all have to understand is a supply chain, because it's a global supply chain, even though the U.S. on a relative basis is one of the best countries in progressing in the vaccinations, the battle with the virus, the economy reopening, that has not happened in many of the other countries. They didn't have $5 trillion fiscal stimulus programs. So I think one of the biggest problems we have with the supply chain that we need to understand is that the Asian Pacific economies have really taken a radically different approach toward the virus. China, Singapore, places like that, they completely lock down an area if there's an outbreak for the virus. They don't just say, well, we're going to deal with it, we'll have people wearing masks. They shut down. And so what's happening, those ports in those areas in the Asian Pacific markets keep getting shut down. They're not fully reopened because they're not back to 100% staffing. So I think that the supply chain is going to be a problem that lasts for more than just 2021. Originally, the hope was we'd see supply chains reopening by the end of the year. I think we all need to be prepared that this is going to be a slower progress and probably could be towards the end of 2022 before we really get those supply chains reestablished. We have seen once again from the U.S., but it's not the same response from the other countries. The U.S. has announced, like the Port of Los Angeles now is going to operate 24/7 to be able to try and get the 60 ships that are out there with supplies sitting out there waiting to be unloaded quicker. So that should help some, but it really boils down to a lot of our supply, whether it's raw material, intermediate goods, or finished goods, come from the developing countries or the Asian Pacific countries. They are further behind in the virus battle. They are slower to get their economies reopened, and that's why I think it's going to be till probably the end of 2022.
All right, that's some good information. So I will pull up the results here for the polling question.
Well, that's encouraging to see from my perspective that 81% of you don't feel another stimulus check is needed. I would agree with that only because they're not targeted. They're broad, and that's part of the problem we had with the first three is that anybody who was making $75,000 or less qualified, even if you're working full time. That gave free money to a lot of people, and that's what created this excess demand right now for so many of the goods and supplies. So I'm good to see with that. Any other questions, Amy, or I'll move to my outlook for the economy?
I can throw one more at you.
Okay.
Why are the official inflation numbers so different than what I am experiencing?
I think we could all probably raise our hands if I asked you, so how many of you are actually seeing the same number as what we are officially reporting, or how many are different? And most would say it's different. The biggest thing I would say is two things. One, the official inflation number has a huge basket of goods and services they're measuring. So unless you're spending on all those same categories, you're not going to have the same results. And especially the weighting would be different, that you may say a big chunk of my money goes to groceries, where with the official one, it could be a much smaller, because for the official inflation number, almost 2/3 of CPI is related to either mortgage or rent. It's housing related, where that isn't necessarily the case for everybody else. They have just as much of expense with gas prices, with grocery prices. So that's one of the issues. The other issue is the way they measure it. It's the way they do it, they're comfortable with it, but it just doesn't reflect reality for the average person, because what they say is that, okay, if you bought a computer, let's just say last year, and you paid $1,000 for it and it had all these features, and then this year you decided you needed to buy a new computer, you're going to buy one that has a better resolution for the screen, faster processing speed, other features that are added in, and it may be the same price as what you paid for the last one. But from the Bureau of Labor Statistics, they say, we have to factor out those added features and compare apples to apples. And most people are saying, yeah, but I'm not buying that old computer. But that's where they may say, hey, the price of computers has actually come down, or the price of a used car has come down, even though in reality you say, what are you talking about? It's almost 25% more to buy a used car. But they would argue, yeah, but the used cars that are out there have better features than the ones that existed a year or 5 years ago. So there's a measurement problem with that. And I just continue to tell people is that each of you has your own inflation rate, and you're being impacted by that. The only real purpose, in my personal view, for the official inflation rate is what the Federal Reserve uses to gauge when to change monetary policy. Whether they think it's an accurate measure for the actual consumer, they don't really care. They're just saying, here's an objective benchmark we can look at, and we want it to be at 2%. And if it starts to get way above that for a long period of time, we're going to start raising interest rates. Where the average consumer says, yeah, but it's already way high, just like you talk to the average business person, what they're paying for raw materials. But that is the reason, those two features. Buying different products compared to what they measure and at different weightings, and the fact that they make these adjustments to try and factor out improvements made to the product that you're currently buying. So let me roll on then. Please feel free throughout my discussion, put your questions in, and then each time we take a break, we'll take another poll, we'll answer more questions for you. So you don't have to wait till the end. My outlook for you is probably what a lot of people are wondering, what Elaine was talking about. What I'm going to tell you, as I talked about with this sugar high economy, the analogy that I'm going to tell you to think about, even though most of us hated it when we took our algebra classes, we all know what a square root looks like, where it comes down, then it goes up, and then it levels off. Well, I'm going to tell you, because of the fiscal stimulus that Congress gave us, we're going to have an inverted square root recovery, which means first half of the year it spiked up. Now it's coming back down for the second half of the year, and then by next year starts to level off. So what I say again is that the days of 6.5% GDP growth in the first half of the year are done and over with, because there's no new stimulus coming from Congress. Then we say, okay, well, what does that mean? And what I'm going to tell you is I think that means that we're going to slow into the 3% type of range second half of the year. Now, in a normal economic expansion, people would say 3%, that's a good number. But a lot of people are saying 3%, oh man, the economy is really in trouble. And I'm like, no, 6.5 was unreal, 3% is realistic. So we just need to readjust, and hopefully nobody was budgeting for next year for what we saw for the first half of this year. And I think you need to, if you're looking at budgeting for next year, you need to be planning for 1 to 3% economic growth, back to the levels that we were seeing for the 10 years after the financial crisis. Because not much has really changed from a broad macro perspective on that standpoint. I still think that's what we'll be looking at. And I think that we could see that happening by 2022 and then carrying forward. I don't see any, in what I look at so far, no indications of a recession looming. I think slowing is different than a recession. So what I try to keep advising people is, look, the economy is definitely slowing, but it is still growing. Just budget and plan accordingly, because there will be opportunities once again, especially if people or individuals started planning for 6.5 to last for the whole year, things like that. There may be opportunities for somebody who's played it more conservatively to take advantage of something if somebody gets in trouble that way. I also think that when we look at interest rates, because this is our Federal Reserve suppressing interest rates, what I would say for a business or for an individual is it completely sucks if you're an investor who has money that you're trying to earn interest on. So a saver who's saving for retirement, or who has retired and now has to live off of their savings, they are going to be facing for at least all of 2022. The Fed currently says they think by 2023 they'll start raising short-term interest rates. But I think the reality is, at least for 2022, we're stuck at these levels where it's horrible for a saver and investor, because they can't earn any type of income on any type of an investment. It's fabulous if you're somebody who's taking on debt. Operating lines are going to remain stable. They're going to continue to sit where they've been for the last 2 years. Long-term interest rate, though, I do think, my view is, and we've seen it this year, is a perfect example, and I think that'll continue into next year. Long-term interest rates being volatile, depending on the news that comes out, things like that. Long-term interest rates can be swinging up and down. And I think from a, especially like commercial lending or fixed rate lending, I think the 10-year Treasury probably fluctuates in a range between 1 to 3%. It doesn't really get below 1%, and if it does, if you're a borrower, you should be taking advantage of that immediately and not waiting to see if it heads towards zero. But when it gets up closer to 2% and starting to push towards 3%, that's an area, once again, I think is going to be volatile. But I think the Federal Reserve would step in if we started to see long-term interest really starting to rise more dramatically, because the Federal Reserve understands Congress has issued a bunch of new debt, and interest expense is tied to that debt, and they want to hold those rates stable and predictable that way. So I think that's why I would say that if we really did start to see long-term interest rates start to accelerate beyond the 3% level, the Fed would introduce a new program. And they had something similar after the financial crisis, what they called Operation Twist, where they stopped buying short maturity treasuries and they bought long maturities to drive those rates down. I think the Fed would start to do the same thing over again, as they would shift their purchases to longer maturities to bring them back below that 3% level. So what that means for the consumer, mortgage rates probably continue or will bounce between, let's say, 2.5% for a 30-year fixed up to 4.5% or maybe 5%. I think it'll struggle if it gets above 4%, because we have a generation of home buyers or prospective home buyers who have never seen 4% mortgage rates. They think 3.5% is a horrible rate because they've been so used to saying 3% or 2.875 or 2.5%. So I think that there's going to be a psychological issue that if mortgage rates really did get above 4% and started to move towards 5%, we'd see housing demand dropping off because people saying, I can't afford it at those levels because they were on the margin as it was. So plan for volatility in long-term rates, but I don't think that we are in a new long-term rising rate environment. I think it'll be volatile, but it won't be a new rate environment at this point in time. Supply chains, that's the big question. I've answered part of that, but I continue to say supply chains are going to be a huge factor, and that's what's going to lead to seeing inflation being higher for longer. The Federal Reserve originally said at the beginning of the year, hey, we know this is transitory, should be done by the end of the year. They were basing that mainly on what they called the base effect, meaning that when we had oil prices down at $10 and $20 a barrel last June, that when they're at $75 or $80 a barrel this June, that's a huge increase in inflation. But unless oil prices continue to go up, next year, if we still had oil at $80 a barrel, just like this year, inflation would be zero because it's measured on a year-over-year basis. So that's what they were saying with transitory. That will wash out by the end of the year. They thought the supply chain would wash out sooner too, but even from looking at their minutes from their last meeting yesterday, they're now conceding that the other part of inflation, due to supply chain shortages or labor shortages, is going to take longer to come down. But I do think that we will still see inflation trending down as we go through time, but maybe not, I think we'll probably be below the 5 to 5.5% range that we're in right now for next year, but we could well be in the 3 to 4% range. Supply chains are still in the process of opening up. The main thing I would say for inflation, why I'm not a proponent to say that we're going to have runaway inflation. One, we don't have the same situation that we had back in the 1970s and the early 1980s, where far more jobs were union-based and they had cost of living adjustments automatically in them. So as inflation went up, the consumer wasn't hurt because their wages went up. Now, far less of that is primarily municipalities that have cost of living adjustments, and some union cases have that. The rest of the people, inflation becomes a self-correcting problem, similar to what we saw for the 10 years after the financial crisis. Whenever inflation started to rise and get towards 3%, the consumer was stuck because the consumer is not the U.S. government. They cannot run a deficit spending. So for them, they can either draw down their savings until it gets to zero, or they can run up their credit card balances till they hit their maximum. But once that happens, they actually have to start to cut back on spending. And the biggest problem for the consumer right now, where they're seeing the biggest inflation increases or price increases, is in the what I call the have to buy items. Your rent, your grocery bill, your heating bill, your gas bill to get to work. Those are consuming more and more of their income, which means they're forced then to cut back on the discretionary spending. So that means that maybe they go to restaurants less, maybe they don't go to movies, maybe they have to drop their Netflix subscription. But I think that's what will happen, is why I don't think at this point that I can make a case to you of it's going to be a runaway inflation scenario. Where that would change, though, and we have to keep a close eye, is what happens with wages. We've seen businesses having to pay higher wages. Does that trend continue? Historically, not saying it's a guarantee it repeats itself, but historically, the Federal Reserve gets concerned if inflation is averaging more than 4% on a year-over-year basis for more than a year. And they recognize that this year it's distorted because last year, when we closed down the service sector with leisure and hospitality and retail especially, those are the lowest paying jobs in the industries. So when you're calculating an average, and in 2019 you had all of the jobs in there, 2020 you basically pulled out leisure and hospitality and retail, that automatically showed higher wage increases. Didn't mean every worker was actually getting a wage increase. It was more of a mathematical thing. Now, as we look at this year, we're still seeing 4% type of wage increases. But I think that the Fed would be patient here, waiting to see if that continues or if it starts to back off as we get the economy fully reopened and the supply chains fully reestablished. So I would say, as it comes to inflation, closely watch the wage situation. And the more that we see big wage gains, the more I think the Federal Reserve becomes worried and says, now we have to start raising interest rates. But I don't see that scenario happening in 2022. The other thing that I would say, we've talked about some, the whole virus situation. I've always said that as the virus goes, so goes the economy. That's what we've seen so far. I think that what we're going to have to get used to, from what I hear from many of the medical experts, is that the virus will go from a pandemic to endemic, which means it'll be just like the flu, influenza, those types of things. It comes back every year. Everybody's going to have to get another vaccine for that. But I think if that's the case, that's a more, I don't want to sound cavalier, but it's a more dependable story there. The businesses can plan for that. People have the ability to go get the vaccines in to deal with it. And we don't have the stop, start type of thing like we've seen with these wave scenarios with the virus so far. But I think the virus will still have an impact to the economy since we don't have a unified response to the virus there. And we have turned a medical situation into a political situation where many people refuse to get a vaccine more on their political beliefs rather than on medical information and things like that. So far less of an impact, I believe, for 2022, but still some of an impact. And finally, I think one of the big situations we're seeing, and the situation is getting worse. It's old news, I think, for the goods producing side of the economy, especially for manufacturing and construction, but labor shortages. How do we deal with these labor shortages? And I think that problem may not be an immediate resolve. I think we're seeing clear evidence that it wasn't just the extended unemployment benefits that kept people from home. We've got childcare issues that are keeping some parents from home. We've got health concerns of people saying it's not safe to go back to work. I don't want to do that. But the other thing that we've seen, something that I've called, and it's not my unique thing, I saw this from somebody else, but it's what we're calling the economics of rudeness. What we're seeing is a lot of people in the client-facing industries, whether it's the airline industry, the grocery industry, the restaurants, the hotels, anything where you're dealing face-to-face with a client, a lot of those people, given how badly they've been treated by customers because of the whole political mixing of this issue, that a lot of people are saying, you know what, I'm done. I can't take this anymore. Healthcare, you're seeing very similar, especially with these waves. A lot of people in healthcare are just saying, I'm exhausted. I can't do this anymore. It's just like a war zone. I didn't sign up for this. So they are leaving those jobs. And right now, we'll see if they get retrained for other jobs. But I think that labor shortages have multiple factors that are causing that. Historically for the U.S., we have to remember the U.S. is a country of immigrants. Immigration has always been a solution for the U.S. to deal with labor shortages. Unfortunately, at this point in time, the U.S. does not have a coherent immigration policy. And I would just give you the example to say, look at Canada. They have far less of a labor problem because they have a very effective immigration policy. It's a means-tested type of policy where you have to prove before you can immigrate there that you can actually support yourself, that you won't come to the country and then immediately go on social support or something like that. But the U.S. is going to need to decide, what do we do with an immigration policy, and learn to separate illegal immigration, which I think the vast majority of the population would agree for illegal immigration, however we define it, we should enforce that. But for legal immigration, the fact that we saw from the last administration that they reduced the number of H-1B visas, the H-2A visas, and just overall reduced the amount of immigration that was allowed, I think that is part of the problem with the labor shortages. We do not have the supply of immigrants who are willing to take up some of these jobs that other people are saying, I don't want to do anymore. So I think that's why I think the labor problem is going to be an ongoing problem. I think as a result, question for a lot of you in the audience as it relates to construction, the infrastructure bill, what's going on there? We know it's hung up right now due to political wrangling, but I do think that ultimately the infrastructure bill will be passed. But what we have to understand is that the question I ask is, so where are we going to have the labor to do all this infrastructure? Are we going to rob from other projects so we see a surge in infrastructure spending, but we see a big drop off in commercial construction or something like that? So labor, very clearly an issue. And I just simply say businesses are entrepreneurs in general. They look for solutions to problems that exist. I would suspect if I'm trying to give a model of how do you deal with labor shortages, if we look at Japan, who's had a labor problem for years because of their declining demographics with their aging population and their practically zero immigration policy, they have turned to automation and robotics. I suspect we're going to see more and more of that. The example I give, the quickest I always think of there, and it's part of my theme that out of crisis comes opportunities. We've all learned over the last year and a half that when you go to a restaurant now, you don't get a paper menu. They have you scan a QR code and there's the menu. The next step, which some have moved to, now you can order on your iPhone the same way, so you don't have to have a server take your order, or they put a tablet on your table so you can order it from the tablet. I would say the next iteration that I would expect if people continue to not want to work in the leisure and hospitality industry, many of you have seen who have college-age kids, these the stories of these robotic carts that go around college campuses delivering books or food and things like that. I could easily see the scenario that the restaurant entrepreneur will turn to that and saying, since I can't get labor or I can't afford the wages they're demanding, I'm going to invest in that. So now you order, you get your menu from the QR code, you order on your cell phone, the order goes to the back of the house, the staff cooks the meal, puts the meal on the cart, codes in your table number, the cart comes to your table, you get your food served to you there. You've solved a labor problem then. You don't need a host, a greeter. You could have, in that scenario, I can see a scenario where you walk up to a big screen kiosk, and you, similar to many movie theaters now, you pick the table that's available that you want to sit at, you go seat yourself. You don't need food servers because a robotic cart can do that, and you're down to basically back of staff being your expense there. That would allow a lot more restaurants to be profitable under the environment we're in. But I'm not saying that's going to happen. I'm just saying that's, in my mind, the type of solution that we'll see from businesses as it relates to labor. So let's take another pause there. Now you know what my outlook for the economy is, growing but slowing. So Amy, if you could pull up the third poll question. And what I want to know from that is, what is your company's current work environment? Are you 100% back in the office? Are you hybrid? Or are you 100% remote? And while we wait for that, Amy, do we have any other questions?
Yes, we actually have quite a few coming through, so I can combine a couple here. Any comments on the home building or commercial construction for the next few years? Are we headed for another housing problem like 2007, 2008?
So I'll go backwards in answering that question. I do not think that we are looking at a housing problem for residential housing like we saw in 2000, 2008. The difference with this is a fundamental supply and demand problem. This is a problem of too much demand, not enough supply. And I don't want to sound like I'm being political or critical, but looking at it, I hold the Federal Reserve responsible for some of this. By suppressing interest rates, they've made mortgages more affordable to more people. And that's what's creating this excess demand, part of it. And yet we've got not enough of supply. So if I want to walk through for you with the housing thing, I'll cover that as things to think about. I'll give you more detail on this. So don't think that I'm trying to avoid answering your full question, because I'll give you more details as part of my description there. I still think on the commercial real estate side, this is going to be a case, again, of out of crisis comes opportunities. It may not be commercial office spaces where the area of growth is, but we've already seen just during this pandemic crisis. I can tell you, I'm in our corporate headquarters in Spokane, Washington, and I can tell you when I drive from there to Seattle, how much I see along the way of the growth of both distribution centers and warehouses, as businesses are deciding that, one, the just-in-time inventory system didn't work when a supply chain breaks down. So now I need to hold more of my inventory close to me. So big demand for warehouses to store that inventory, whether it's 3 or 6 months worth of inventory. Distribution centers, because everybody wants their goods, yesterday. It isn't just Amazon. You got Walmart, you got Target, you got all of those type of places building out these distribution centers to have their inventory closer to where the consumer orders it. So when the online order comes through, they can deliver it quickly. We've also continued to see good demand in the self-storage, because what we've learned with the baby boomers is even if they've decided to downsize to a smaller house, they're unwilling to make the decision of what they need to get rid of. So they stick it into self-storage and they say, the kids can worry about that when I die because I emotionally can't bring myself to get rid of this stuff. So we've seen good demand there, but there's going to be other areas. I still think, we don't know the final story for commercial office space. Are we going to be permanent hybrid? Is it going to change? Are we going to go back to more in-person because we need collaboration? I think that's an influx area. And we know that, like for commercial retail, that was already in change before the pandemic. The pandemic just fueled that for faster changes. So we will probably see new forms of retail, maybe smaller office, smaller footprints in more places, something like that. But I'm not a pessimist to say that we're going back to the 2007-8 era, where we had in many cities what they call the see-through buildings. I can remember being down in Southern California, and you could just see straight through a building because the whole building was empty. I don't see that environment. I just think that we may change ownership. Some people could get washed out in this process, but there will be new people coming along because I still think with population growth and everything else, there will still be demand for the commercial real estate side. The challenge for commercial real estate, no different than residential, it's labor costs and supply costs. With supply shortages and labor shortages, it's just going to make it that much tougher to find new ways to do it. And that's where I think automation and robotics may play a bigger role going down the road.
All right.
Another question?
Would you like a question?
Yes, please.
Do you think the Federal Reserve has made the right decisions in buying bonds and suppressing interest rates?
I think the Federal Reserve made the right decision in the middle of the crisis. They had to ensure that we weren't going to have another Lehman Brothers event where Wall Street almost collapsed. So their initial move, buying $120 billion in government securities, flooding the market with liquidity, I think that was the right move. But we're not in that crisis situation anymore. I think the Fed now is making a mistake, that they are staying involved too long. They're distorting the financial markets as a result. We're getting misallocations of capital. People that normally would be looking at fixed income type of investments are now buying stocks, even if they don't understand the risk of a stock compared to a bond. And we're pushing more people to real estate as well, because the lesson we learned after the financial crisis, when the Fed was intervening with their bond purchases, the two asset classes that performed the best were real property and stocks. Right now, real property has a little more question about what the new future looks like. So it's been heavily dominated with stocks. So I think that the Fed is now making a mistake when they made the right decision originally.
All right, let me pull up the polling results here.
So not surprisingly, the majority, 57%, are working hybrid. Interestingly, though, almost 30%, 100% in the office, and only 14%, 100% remote. So I think that is something. Let me go ahead and move on to the things I think we should be thinking about, and we'll take some more questions if I didn't answer them during what we're thinking about. The one area we definitely need to be thinking about was the question that came up, and I would say very definitely we need to be thinking about this. It is the whole housing scene that we continue to see, and I say once again, the Federal Reserve is a contributor to this. But really what I would tell you is what we have to understand with housing, why I don't think it's a housing bubble. There's several factors that are driving demand. One is the fact that, cheap, affordable mortgage rates. I would say personally, I don't see the harm in letting mortgage rates go to 5%. Normally, if you got excess demand and you're selling a product, you raise the price until you hit a point where the demand levels off or drops off. I wouldn't see a problem with letting mortgage rates go to 5%. And having some of this demand dropping off as people have to save more for their down payment or to afford the mortgage payments. But there's other factors on demand. One is population, not necessarily for the U.S. as a whole, but in certain areas. So when I look at population, what I can tell you is for the U.S. over the last year, population grew just basically 1%, 0.9%. But when I'm looking like the top area for growth for population, people migrating and going to that state, it was Idaho. They had 2.1% population growth. And where were they leaving from? I'm not saying this is true. I'm just giving you the analogy. The worst state for population growth was New York, where they had a decline of 0.65%. Lots of people leaving New York, going to Florida, going to other places like that. So we've definitely seen a shifting in where the population is growing. And I think that affects housing in that sense. It's gotten to the case, just using the microcosm for Boise. This was, it's a next tier city, but suddenly they're just getting inundated with people, which is great for the city to have new businesses and stuff coming. But what's happened now is their home prices have just gone through the roof. When I look at like the National Association of Home Builders, their affordability index, what I see is that Boise 5 years ago, 65% of the population could afford to buy a house. At the end of the second quarter, 21%. And the problem is the people coming to Boise are saying, no, these home prices are great because I sold my house in California or I sold my house in New York, got cash. This is fabulous. But for the average worker who was already there, it's horrible. And so what's that done? That's pushed a bunch of people into rental properties. And now, an average rent price in Boise is over $1,500. And yet Boise is in the bottom 10% of the U.S. for wages. So what we're developing as a situation now is what I call the Sun Valley effect, that the worker who works there can't afford to live in that city. They have to move half an hour away before they can find somewhere they can afford to live. And that's going on in many different cities or regions throughout the U.S. The millennials are also a huge factor, not a bubble. The millennial generation, biggest generation in history, they've reached the age where they are now getting married, they're having kids, they want houses. That demand is a fundamental driver right now of home prices as well. And the last one, which is troublesome to me, but not much you're going to do about it unless cities or states or the U.S. starts to put in some type of laws to prohibit it. But what we're seeing is because investors can't, get any type of interest on the traditional forms of saving or investing, bonds, savings accounts, things like that. What Wall Street has learned, they learned this after the financial crisis. Hey, let's go into Arizona, let's go into Nevada, buy up all these defaulted homes, put a little bit of paint on them, fix them up, and then we can sell them as rental properties. And we put them into a pooled fund, and then the investor can invest with us. We earn the rent, we take our profit margin, we pay an interest rate to the investor that's still better than what they can get on a corporate bond or a treasury security or a savings account. That is happening again. They are buying up homes to turn into rental properties, and with many places having vacancy rates below 5%, some of them below 1%, plenty of demand, so they can charge hefty rent prices. That's taking housing off, inventory off of the market that normally would be available for new home buyers. Perfect example, there's an article in the Wall Street Journal a couple of months ago, a 350 unit housing development in Texas never went on the market to home buyers, was sold to a Wall Street private investment firm like a BlackRock or something like that. They turned that whole housing development into rental properties, and they've got it fully rented out now. And so their investors with them are making a nice income return compared to what they could have gotten on anything else. So those three are the major drivers of demand. What's going to slow that demand in many cases is going to be when housing reaches a point it's just so unaffordable that people say, I can't buy that. I can't afford that. And in many cases, like a place like Boise, businesses looking and saying, hey, Boise's still very business friendly. Let's look at relocating to Boise. Oh, wait a minute. They don't have any housing for my employees, or my employees can't afford this housing. Let's go look somewhere else. And so I think that's the perspective that I give you, is that housing is a big issue. When I give you the example, I'll look at the National Association of Realtors. The median home price for the U.S. rose 23% from February 29th, the end of February 2020, until August 31st of this year, a 23% overall increase. For the best city, and I say best means the least increase, if you want cheap housing or cheaper housing, you should move to Washington, D.C., because their home prices have actually fallen 11% over that same time frame. But you don't want to move to Montana, because Montana has seen a 52% increase in home prices over that basically year and a half time period. Boise or Idaho second. So that just shows you how expensive it's gotten there. On the supply side, what I would tell you is supply and labor, as I've already talked about. The other is government issues. Ever since the financial crisis, much more bureaucratic red tape and regulations to actually be able to build residential property and commercial property. The other for residential is what I call the NIMBY mentality. Not in my backyard. People don't want it near me. Go take it somewhere else. And so where they want to try and build houses, they're fighting, these people that are fighting zoning and things like that. And the last thing, as I talked about before, is investors pulling supply off of the marketplace. That's why I don't think it's a housing bubble. I think it's going to take more what I would call, using a flat tire example, this is going to be a case of a slow leak in your tire that eventually goes flat. As prices get too high, people can't afford it, demand drops off, prices start to drop. But it's not going to be like a blowout where your tire blows out because of an excess of bubble there. The other thing I think we always have to think about is tax policy. We know that we're probably facing higher taxes for the higher net worth, but businesses especially facing higher taxes. You guys are the expert on that, so I'm not going to give you much insight there other than saying that that is, every dollar you pay in taxes is money that can't be used for some other type of spending. And those taxes aren't necessarily going to be dedicated to projects or other things that will generate new tax revenue for the government. So we have to watch tax policy. And I think the last thing I would tell you is we have to watch workforce migration. Is remote work going to become a permanent thing? Or will we discover that, hey, we really do lose collaboration, the instantaneous meetings where you can brainstorm on something, things like that? Or do we say, hey, we're going to allow 100% remote as a permanent policy? Because the one thing I've tried to warn even my own employees is saying, hey, be careful what you wish for. Because if you stop and think, if corporate America decides we will allow 100% remote work, well, then the next thing is, okay, so now that we're allowing 100% remote work, where's the cheapest source of that labor? And guess what? It's not in the U.S. You can probably go to India to get experts in accounting, technology, finance, plenty of service sector industries where you say, oh, we're not at risk. That's only at risk of outsourcing, manufacturing type of things. That's where I just say is we really have to watch and see what happens with workforce migration, because that's going to be a real determination for businesses. But I do think it's not going to be, we've seen what I call a bulge impact to housing as well for these people making this move to a new city. But now that we've done that move, businesses will no longer hire somebody in San Francisco and then let them move to Boise, Idaho. They'll just hire people in Boise, Idaho. So I think that those are the type of dynamics we have to be thinking about. I don't have any great answers, but those are the thoughts I want to leave you with. So let me go to our last round of questions. Amy, if you could put in our fourth poll, we will get that answered as well. This is what's the biggest challenge for your industry or business? So while you're answering that, Amy, why don't you throw the remaining questions you have at me until we run out of time? Well, actually, let's do for about the next 2 or 3 minutes, and then I'll conclude because I know that you guys have some conclusion comments you'd like to make as well.
All right, sure. So this is a big one. What keeps you awake at night as it relates to the economy?
What keeps me awake at night is rotating back to our friends at the Federal Reserve. I just worry heavily that they're creating a mentality in Congress that, hey, we can issue all the debt we want to issue because the Federal Reserve will keep interest rates low and we're never going to have a big interest expense bill as a result. And there's even some of this belief that the Federal Reserve, if things started to get problematic, the Federal Reserve will just buy up all of our debt for us, similar to how the Bank of Japan owns 2/3 of the Japanese debt. So I worry a lot that there are no longer either political party because we saw deficit spending from the Republicans during the Trump administration. Now we see it from the Democrats. There is no voice out there anymore that says, whoa, wait a minute. Somebody's got to pay this debt off sooner or later. And it's going to be our grandkids or some generation after that. So that's really what keeps me awake at night is that we're developing this mentality that money is free, debt is great, take on as much debt as you want and spend as much as you want because the Fed's got our back.
All right, here's another one. Social Security funds are set to run out a year sooner than originally projected. How do you think this will affect our economy, and do you think the government will intervene?
I absolutely think the government will intervene. They'll do something, whether it's magic accounting or something like that. But Social Security has become the retirement system for so many people, even though it was never designed as that. If we remember the Social Security Act, originally it was designed as a safety net. So if you outlive the average lifespan, there was a safety net for you. And at the time when it was passed, there was a 5-year difference between the average lifespan and the qualifications for getting Social Security. So 5 years younger than the average lifespan, with the thought being that you might use it for 5 years, but not much more than that. Well, if we would have stuck with that, then we'd be at the point now where the average life expectancy is basically 70 years. Then you've raised the minimum age to qualify for security, higher than where we are now. You're up into 65 years or maybe more than that. I think there's a very simple solution that nobody wants to talk about, and that would be the case that we're not going to break the promise to the existing people. We got to stop the flow of new people in, and a simple way to do that, which would cause plenty of screaming and shouting, is raise that qualifying age, to the same as life expectancy, or maybe even a little more than that. Doing that would greatly reduce the liability for the country. But I do think that there's no way that they're going to let that. It's similar to the debt ceiling. Lots of noise. What I always say is, when in question, when in doubt, run in circles, scream and shout. That's what Congress does. Ultimately, they pass the debt ceiling, and they'll keep passing the debt ceiling. Same with Social Security. They'll keep putting patches to it to extend it out until ultimately it's more of a problem as does something happen with our overall debt versus Social Security. Well, let me go ahead and wrap it up there. I know we have about 5 minutes left. My concluding comments to you are fairly simple. First, if we look at the result of the polls, you confirm what I hear so much from all of our businesses. 45% of you are saying your biggest challenge is labor shortages. The next one after that is COVID disruptions, and then supply shortages. So we're all experiencing similar things with what we're seeing there. I would just simply say again, when we have these types of challenges, when we have these types of disruptions, I always say out of crisis comes opportunities. And I would just continue to always say, be the one who's focusing, looking forward, saying, where are those opportunities, rather than the one who's hiding under the desk saying, just tell me when it's over so I can get back to normal. Because the one reality we all know is that there is no normal. I mean, the new normal is going to be different than what pre-pandemic there. We all have to adjust, but from that, there's great opportunities. So I hope everybody has a chance to take advantage of it. And with that, Amy, I'll turn it back over to you guys. Thanks for having me.
All right. Thank you, Steve. And thank you for a really informative presentation today. We truly appreciate all of your insights that you offered to all of us. And then also, I want to thank the audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. And then also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. And we'll keep the console open for a few minutes to give you time to download. And a copy will be emailed within 3 weeks should you have any difficulty downloading it now. And then also, as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here's a link to an online survey for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again for the next session in our Building Opportunity Conference, which is next Tuesday, October 19th. Take care. Thank you, Steve.